Hello folks, welcome back to another session. In this session, I'm going to explain the Elliott Wave Theory from head to toe. So, if you are a beginner trader or even if you are a professional trader, still it is extremely important to have better grasp on this topic. So today we will delve deep in this theory named as Elliott Wave Theory. But before I start the session, I will plead to kindly like and subscribe my channel. So what happened by analyzing closely 75 years of stock data and when the Ralph Nelson Elliott turned 66, he finally gathered enough evidence and confidence to share his discovery with the world. And that discovery is the Elliott Wave Theory. Initially, this theory was named as the wave theory, but later it turned as the Elliott Wave Theory. So, according to Ralph Nelson Elliott, the market trades in repetitive cycles. Like as I can show you on the chart, the market is going down, the market is going up. So there are circles that the market makes, or there are waves. Let me show you the illustration of this theory. According to him, the market moves in five waves. Initially, when the market changes its direction, it forms a reversal pattern as written at the top at this point. It is a reversal pattern which the market formed to change the direction of the trend. Then the market makes the first wave, which is known as wave 1, which is this one. Then the market makes the second wave, which is named as wave 2. Then the market makes the third wave, wave 3, then wave 4, and finally it makes wave 5. The five waves, like I mentioned at this point, the market will eventually form a reversal pattern, a head and shoulder pattern, or a double bottom pattern to change the direction of the trend. So the double bottom pattern or the inverse head and shoulder pattern are the reversal patterns which change the direction of the trend. So after this pattern, the market will again make the first wave, wave 1, which is this one. Then the market will make second wave, which is wave 2. Then the market will make wave 3, wave 4, and finally it will complete its 5 waves, or it will complete its circle. So after completing the 5 waves, the market will again make the reversal pattern. The market will form the reversal pattern, and soon after the formation of the reversal pattern, the market will change its direction to the downside. But there are three cardinal rules of this theory which I will like to share with you. These are like the first one, the first rule of the Elliott wave theory is that the wave 3 can never be the shortest impulse wave. Let me show it to you. Here at this point, it is wave 3. What is impulse move? Impulse move is the move which helps the market to continue its trend. While it can be bullish trend, it can be bearish trend. So we saw that this wave is bigger than the first wave, and even it is bigger than the fifth wave. So the rule is stating is wave 3 can never be the shortest impulse wave. And I can show it to you this example on the bullish scenario too. Like here at this point it is wave 3. it can never be the shortest impulse move. What is impulse move? Again, the move in the direction of the trend is known as impulse move. And this one is retracement move or correction move. Okay. And this one is also retracement or correction move. Again, this move or this wave is an impulse wave because in the it is toward the continuation of the trend, and it also broke the previous high, so it is a impulse move. The second cardinal rule is stating that wave 2 can never go beyond the start of wave 1. Let me show it to you on the illustration. Like it is wave 2 at this point, it can never go beyond the start of wave 1. So where the wave 1 started, it started at this point. So wave 2 can never cross this point. And if you are a smart trader, you will just place your stop loss above the start of wave 1. In this case, your stop loss will be less likely to get triggered in the market fluctuation. In the bullish trend scenario, it is the wave first and it is the wave second. So the second wave can never go beyond the start of wave first. This is the start of wave first. So again, you will place your stop loss below the start of wave first. This way your stop loss will be less likely to get triggered. This was the second cardinal rule of Elliott Wave Theory. Now let's move toward the final rule of this theory, which is wave 4 can never cross in the same price area as wave 1. Let's see how this works. Wave 4, which is this correction move, can never cross at the same price area of wave 1. Like the price area of wave 1 is to this point, and wave 4 can never come to this point. Okay, like let me stretch it. This is the price area of wave first. In the bearish trend scenario, in the bullish trend scenario, the price area of wave first is this area. Like it is the limit, it is a border which the wave 4 can never cross in the Elliott Wave Theory. So what we will do when the market makes the wave 4 and when the market make the retracement move, we will simply place a stop loss below this point. So this was all about the illustration and rules of Elliott Wave Theory. Now let me show it to you the example of this theory on chart. So what was happening at this point? The market was in a clear downtrend. The market was making lower lows and lower highs. Then what happened? The market formed a reversal pattern, which you can say this was the first shoulder, this was the head of the pattern, and this was the second shoulder, which completes the reversal pattern. So after this, what happened? The market made the first wave, which is the wave first. Then the market made the second wave, which is wave 2. And as it is stated that wave 2 can never go beyond the start of wave 1. So it didn't go beyond the start of wave 1. So we can place a stop loss at the below the start of wave 1 at this point. Let me straighten it out at this point. Again, the market completed the wave third. As it is stated, the first rule, the first cardinal rule of Elliott Wave Theory is that Wave 3 can never be the shortest impulse move. And I explained and defined what is an impulse move and what is a correction move. We can see Wave 3 is the longest impulse move in this trend. Then the market made wave 4. After that, the market completed wave 5. So what happened? The last rule of Elliott wave theory is that wave 4 can never cross in the same price area as wave 1. It was the price area of wave 4 and the price area of wave first is up to this point. We saw the market, the wave 4 never crossed the wave 1 price area. So when the market completed 5 waves in this bullish trend, the market formed reversal pattern. This pattern, which is a, you can call it a double top pattern, you can call it a head and shoulder pattern, or you can call it a QM pattern. Why I'm calling it a reversal pattern? Because the market formed first shoulder at this point, the market formed head of the pattern, the market changed, the market broke this low. See, so it confirms that the trend has changed, and again the market formed the second shoulder. So it is a reversal pattern. It is either a top, double top, or you can say it is either a head and shoulder pattern. So what happened after the formation of this pattern? The market made the first wave. It is the first wave, wave 1. Then the market made wave 2. Then the market made wave 3. Then the market made wave 4. Then the market made wave 5, which was the longest wave in this example. But it doesn't matter because the important rule is stating that the wave 3 can never be the shortest impulse move. Okay, so there might be cases that the wave 5 may be sometime the longest impulse move in the trend, but we will make sure that the wave 3 is not the shortest. And if we see the wave 3 start from this point to this, and if we compare it to wave first, so it was larger than the wave first. So it is obeying the first rule of Elliott wave theory. Then what is the second rule? The second rule is stating wave 2, like this, wave 2 can never go beyond the start of wave 1. Wave 1 started from this point. From this point. So what we will do, we will simply place our stop loss above wave first, while the market makes the wave second. The last rule is stating that wave 4 can never cross in the same price area as wave 1. So what happened? The wave 1 price area was at this point, and this was the wave 4 price area. So it didn't cross. What happened here? The market just broke this low and retested it, which became a flip zone. Okay. This is how the market completed the 5 wave circle. And it is true the market, like the wave theory, the market trades in repetitive cycles, because again if we see at this same chart at this same time, the market formed this reversal pattern again. Like it was the first shoulder, we can consider it the double bottom pattern too, or we can consider the double bottoms the head of this pattern and first shoulder, and we can, yeah, we will consider it the double bottom pattern. So what happened? The market formed first wave, the market formed second wave. The second wave didn't go beyond the start of wave 1. This was the third wave, wave 3. This was wave 4. This was wave 5. And what happened at this point? The market formed a reversal pattern, the double top pattern. So if again we look at this chart, the market is making these patterns, these waves in the bullish and bearish scenarios. So guys, I showed you the illustration and then I showed you the rule of this Elliott wave theory. Then I showed you example on the chart. But still, if you are having any sort of predicament, you watch the video for one extra time and then all your confusion, all your errors will be corrected. And let me know in the comment section that how this theory helped you in your trading journey. See you guys in another learning session. Take care.